Hi, I'm Adrian Helfert, CIO with Westwood Holdings Group. We're here to give you an outlook today on the economy, some opportunities, and we'll talk more about this. As it says, we're here to be clear-eyed, not perma-bullish, not doomish. We're here to be looking at fundamentals and clear-eyed about the potentials of the economy as well as the risk on the downside. And that clarity now looks reasonably positive for the upside potential. I promise you three things today. One is we are going to look at where we are in the cycle. We are believers in an investment cycle that has ups and downs through the cycle. We're going to look at what's changing through the investment cycle, and we're going to look how we're positioned to capture potential from the investment cycle. If we go to the first slide, 2025 really defied the playbook. You look at what we faced, which were extraordinary, unexpected tariffs potentially taxing the economy, new policy change, an incoming administration with uncertainty around things that might happen, a government shutdown that was the longest in history. At the same time, we had geopolitical forces and risks that were prevalent, sticky inflation that was above 3%. Not going through all of these things, but we had some pretty significant risk that we faced. What actually happened out of the back of that? Well, the S&P 500 was up 16%. The NASDAQ was up 20%. Those two in isolation tell you that we looked further past the risk to say there's growth potential and productivity increase potential as a result of various forces in the economy that we'll discuss today. Fundamentals mattered more than fear in this economy. And when we talk about clear-eyed, that's what we're looking at. There's always the things to be scared about. There's also the potential of looking forward and saying, what are the growth drivers this year and in subsequent years that can help us drive our outlook? Where are we in a cycle? I generally do think about investment cycles of being around an 8-year cycle. This one is significantly longer. Since the global financial crisis, the average return on the S&P 500 has been up around 16% plus. So that's not your old proverbial 8 to 12% equity market. We're seeing more growth. Does that mean we're in a late cycle? We see some of the signals out there that could preface a late cycle drawdown. Cost cutting is being more prioritized. We're seeing some buybacks over capital expenditure in some of the smaller companies. That's a signal that we're getting. But at the same time, we've got another signal that's occurring here, which is early cycle. And really, the biggest one of all is the Federal Reserve is cutting interest rates still. Whether they cut this coming meeting or whether they hold for a while and then get to what they call a neutral rate to balance the economy, we're going to a lower, more accommodative interest rate on the economy. And that's positive. The Fed's in easing mode. We've got fiscal policy that's reasonably supportive. We've got early cycle tailwinds that are on that front of things like the big beautiful bill that is going to, with tax changes for consumers, there's somewhere around $3,000 to $4,000 on average that the average taxpayer is going to have in tax refunds. And on average, they spend 80% of that. Our economy is consumption. Around 70% of our economy is consumption. So that's a really good signal for the possibility of an impulse in 2026 for consumption. So we are in an unusual cycle. We believe there are some transitional signals that we're seeing, but it ain't done yet. The punch bowl is not getting pulled. When we look at the macro landscape, which we will now, we're going to kind of break the economy into demand. That would be the consumer side, as we've discussed, and supply, which is capital expenditure, jobs, wages, and see where we balance. And we'll talk about where we are different this time, so to speak. The overall health, I often think in terms of a vicious and a virtuous cycle. That cycle really often begins with consumer confidence. You feel good. You can walk across the street and get a job. Your bonus is going to come in. Your household is employed. So you go spend, you buy the fancy car, the trampoline in the backyard. That's consumer spending. And as you increase that, as we as a broad force increase that, that's capital expenditure. Companies buying more machinery to manufacture the widgets. And when they do, they hire people to manage the machines and people to manage the people managing the machines. You get the point. This is a cycle that is a virtuous cycle that goes through. As they do that, then Supply demand takes hold, more demand for the same supply of jobs, and wages rise. You feel good, your wages are going up. Thus is a virtuous cycle. So I look for where things aren't working now. We're not really going to have a recession without one of these pieces that aren't working. If I look forward, well, the demand side cycle, as I said, that's primarily consumer confidence and consumer spending. Consumer confidence is a little bit in the doldrums. It hasn't been looking good. It's down 20% on many measures from where we were last year, and it's at cycle lows. We just saw, as of today, I'm recording this, February 25th, interesting data coming out telling us confidence is starting to look a little better. People are looking forward for potential, but it is still low. That said, the consumer is still spending. It's a resilient consumer. It's not as leveraged as it has been in past cycles. There is a bit of a change, though. It's primarily driven by high income earners versus low income earners, which also changes the mix of goods that are in the consumer spending basket. But to note, that's providing a pretty good impulse to the market. 70% of our economy, consumers are still spending. If I look at the supply side, capital expenditure, wow. I put $650 billion on this slide that's just the top 4 AI-driven companies that are spending, that they've announced that they are going to spend just in 2026. That number's already gone up since I put these slides together. It's extraordinary. Just Amazon alone has said they're going to spend $200 billion on capital expenditure, which is primarily artificial intelligence-driven capital expenditure for 2026. To put it in context, that's about the gross output of Greece. This is an extraordinary time that we are living in. This is just the top 4 companies. We see more than this, and it's been growing significantly. Will that create jobs? Well, I mean, the hottest job market in America right now might be data centers, and jobs are going up. So they are in confluence as it stands right now. We'll have several questions that come out of this. Number one is on capital expenditure. Is this just an AI cash bonfire, as some have suggested, that we're burning up because companies are worried about existential crisis of not being able to stand on their own 2 legs because AI native entrants are eating their lunch? Or is it really going to be the return on investment of the future? We're watching that, but we do believe more in the latter. And jobs, is this a short-term impulse? There's a lot of new jobs going into AI-driven areas. Let's call it, for instance, building data centers. Once you build a data center, those jobs are not near as much needed. So is that a short-term impulse versus sustainability? Something we are currently watching for, and that's a bigger point for us. So the cycle is positive, is what we see, but the rules are changing a little. And one of the rules that I want to point to is generally in my decades of looking at this, we talk about a capital expenditure to jobs transmission. As companies are investing in their business because they see future demand and potential and growth, that leads to job growth. Job growth leads to future demand growth, that virtuous cycle. Is that different this time? Well, we are rewiring that just a little bit. I talked about the data centers. We've got high capital expenditure, but it's going into areas that are high productivity and not high job intensity. So something of note that we will be watching for, that's a changing portion of the cycle. And one of the key questions that everyone asks, of course, is, well, but if unemployment is going to start rising because we're going to get all this productivity coming out from deployment of artificial intelligence, who's going to be spending to support the economy? It's kind of where we are now. Of the consumer sentiment is not so great, but people are spending. Does that come down? Generally, if we have high productivity, if we have high output, if we have high good returns and a wealth effect, we should still be a good, healthy economy. But it's something of note that we'll be watching both jobs and consumer spending. If we look at what our outlook is, our true outlook on the numeric basis, we are a higher real GDP growth outlook than the overall market. That's in total output of the economy. We think the productivity will occur earlier than many expect. And it will occur not just with the hyperscalers, the uber large mega cap companies, the Mag 7 often as we would refer them to, but with mid cap and small cap companies. If we look at inflation, inflation is an interesting one. I believe that inflation and technology go hand in hand, but technology is actually a disinflationary force. As we see entrants that come and have capabilities that other companies can handle, that competitive force is going to push down margins to some degree. It's going to be offset with productivity. That's something we will monitor for. We are constructive. We are looking for a strong earnings growth. We're just coming out of a fourth quarter earnings this fourth quarter, and it's looking pretty good. We're seeing about 12% earnings growth across companies. That is easily supportive of a reasonable market. Not euphoric, but constructive. Have to point to valuation. Of course, valuation tells you how expensive things are, but it's not a sign of panic. That's a difference. It is very high right now. You're paying a lot for each unit of earnings by the most basic metric of a price to earnings ratio. But that doesn't mean that we are set up for some major signal that says a crisis is ahead. But it does mean that if we do hit a stop in the economy, then valuation could compress significantly. What it is also telling us is that there's a much larger proportion of technology companies in the indices now that are driving a higher price per unit of earnings, because we extrapolate out growth usually with a higher PE ratio in technology companies and growth-oriented companies much higher. So it makes a little bit of sense that it is more expensive. Where we find opportunity is often looking down in smaller companies where we are going to see the broadening. Let's talk for a second about what we need to go right and what might go wrong, the things that might go bump in the night. The things that we need to go right: earnings deliverance. We need to see companies realizing earnings, not just saying they're going to realize earnings. And we're seeing that. As I said, we see 12% earnings growth out of the fourth quarter. Happy to see that companies are projecting a pretty reasonable path ahead as well. But we need to see realized in 2026. That's going to be very important for us, not just telling us that the path ahead is rosy. The consumer needs to keep spending. Some of the signals we've gotten more recently have been for pretty reasonable consumer sentiment. So I like the backdrop of where we are in consumer spending. I like the backdrop of the health of the consumer overall. I don't think it's an over-leveraged consumer, but the signals we'll be watching will be things like auto loan delinquencies, and to see if consumers are feeling more pressure upon them. That's something we will watch. And policy will ideally stay supportive. Policy staying supportive means projecting a neutral rate to balance the economy for the Federal Reserve's rate of lower than where we are now. Right now, we are at a base rate that is expected to drop another 75 basis points overall before we come down to a lower base rate. We've already cut rates significantly. Just having that capability, it's not because we will, but because we can, to suppress volatility, is going to be supportive for the economy. Things that could go bump in the night: we're going to watch labor markets. That's a very important one. That could see an impact from technological innovation if we don't use our innovation and our human ingenuity in order to create new pathways. I believe in human ingenuity. I believe in creativity and creating new companies. So this will give us capabilities of creating new margin expansion potentials, of revenue pathways, and then spending against that. So I am more positive, but we could see unemployment rise as a result of efficiencies in the near term. Otherwise, AI return skepticism we're going to have that for, I believe, the next at least several years until we see realized earnings. We need to see realized earnings come as a result of companies deploying this. We've seen some of this already. Walmart, for instance, told us last year that they saved somewhere around 30 million miles of logistics and transport of goods because of the utilization of artificial intelligence-driven transport solutions. That's real savings. That's real trucking cost and gas savings. So certainly notable we need to see more of that, of smaller mid-cap companies that are finding opportunities. We are coming into the second year of a presidency, and regardless of party affiliation, it's an interesting dynamic to look at. The second year of presidency is often when, one might say that we had the first year, which was the honeymoon, and the second year is now the bill is due. The bill is due. We've got midterms coming up, and we're going to be effectuating some policies that may not be as stimulative as promised at the beginning of an incoming presidency. That's generally, it actually is a pretty good statistical significance to show that the second year of presidency is often the least appreciative in an equity market scenario. So something we'll be watching just as a seasonality narrative. The big idea from us this year is looking at the broadening trade of looking at small caps and mid caps that could start to outperform as they realize. If you start to look, you'll see the valuation gap has hit a pretty extraordinary level. And the valuation gap shows that right now, something like the S&P 600, so let's talk about the 400 and the 600 small and mid cap stocks, trading at about a 25% discount to the S&P 500, which are generally large cap stocks. That puts us in the framework of what we like to see as investors. As investors, from our framework, what we like to see a significant discount, a measurable downside that says if a recession hits, if we see a downtrend in the economy, we're positioned for that. We have a base level and we can price out what earnings might look like. The upside is if the economy holds, if we start to see this broadening and realized earnings come to companies, we could see a significant relative outperformance to large caps. And then we look at the base case that favors where we are right now, our base case being reasonably positive, that earnings are coming in reasonably strong and showing realized opportunities. We're going to see a movement together of small cap versus large cap, mid cap versus large cap. Therein lies opportunity for investors that we're going to help them take advantage of. Fixed income, don't ignore the yield in fixed income. It is still elevated over what it has been in about the prior decade. So that's reasonably positive. You can gain a reasonable yield for having protectivity sitting on the sidelines, and that yield actually looks reasonably attractive relative to an earnings yield on the S&P 500. Things that I'm looking at on that are things like the potential of an inflation premium longer term. If we are more stimulative than the economy demands, the inflation markets will recognize that, and bondholders will become more scared about the deteriorating value of a long-term holding of a bond, which is why we are less sanguine on long-term holdings of bonds and more excited about short-term holdings of bonds. But as we look at it, the overall opportunity looks reasonably attractive if you just think yields alone and not these spreads, the compensation for default risk. You're getting around 5% on investment grade corporate bonds. You're getting almost like 7% plus on high yield bonds. 7% in a market where maybe we produce 10, 12% on the equity market is not so bad. With a lower volatility, you might end up with a better risk adjusted return, and the mix of those is best of all. I wanted to delve into just a little bit artificial intelligence, where we are. We have gone, we believe, a little bit from the build out phase. There's a cycle and a build out phase of new technologies that occur as well. We've seen that in multiple areas, everything from the steam engine to the internet. So we've gone through a build out phase. That build out phase is still going. That's things like the hyperscaler CapEx. These are the large companies that are making the picks and shovels of the AI revolution. To now we want to see the harvest. I've talked a lot about the realization of earnings, and we want to see realized earnings come as a result. Show me the return on investment will be the narrative of the year. CapEx increased, capital expenditure increased 69% in 2025. And when I started looking at this, I had 30% as the expectation for 2026. That subsequently increased to 60%. So capital expenditure in that area is looking to increase another 60% in 2026. The build out isn't done, but we want to start to see the harvest. We want to start to see margins maintain, increase as a result, and new revenue pathways. If we look at what AI really means in certain areas, I spoke a lot about this live recently, and there's a lot of questions people are coming around. Well, how capable is artificial intelligence. It is certainly beyond just being a chatbot, just being a Google better chatbot that you can go in and it gives you great answers on something. It's building things. It's taking out full areas where previously you might have had to spend a day doing something. It's now capable of doing that. And that's what this is telling you. On a capability metric, it's been doubling every 6 months. Recently, they just announced that it's doubling its capabilities every 4 months. We started back when I first spoke about this actually in 2022, and it was find things on the internet and make some reasonable estimations of what it means very quickly. That's helpful. That's like a Google taskbar plus. We are so far beyond that this is no longer a chatbot. This is now multi-hour research. This is now a full workday autonomy. A query can do what some humans are doing in a full workday, and it does it in a very fast period of time. Companies are able to deploy this in order to find efficiencies. It doesn't mean reducing the employment. It does mean finding areas where they can focus for greater realization of productivity, new revenue pathways, new margin expansion. That's what we are seeing. But certainly it is the narrative of the day that is still going. If I close this up with some of the key points, rate cuts have already started, just now. We are headed to a lower neutral rate than where we currently are. As a big picture, don't worry too much about whether this year, how many cuts we actually do. As long as we are on a path to move lower and have the capability of moving to a more accommodative stance, then that's going to facilitate further growth during a period when we can identify a growth paradigm. And that growth paradigm is enhanced productivity growth, its margin expansion, its new revenue pathways as a result of artificial intelligence. The business fundamentals are reasonably solid. We don't have an over-leveraged economy in high-quality companies. We are seeing a little bit more leverage added, and certainly those that are looking to keep up almost with the picks and shovels in AI, and so they're being forced to go borrow and enhance. But we're not at a super elevated level yet that is concerning for us. We're always looking for the shadow leverage. There is some of that in private credit, where private credit is a growing sphere, and certainly has been. And we're keeping a close eye on those that have an overabundance of things like software names that could be impacted versus those that are invested in other areas. But that's not a systematic risk as we sit and speak. The consumer is still resilient, and jobs market is still, even at above 4%, which is not where we want unemployment to be. We're at a reasonable place where it can support the level of spending that has supported the last several years of the economy. Fixed income remains valuable as an insurance policy. We do have elevated valuations in the equity market. And as I said, while that is not a sign of a crisis, it does mean that we have effectively further to fall if we hit a stop in the economy. And in that instance, fixed income is valuable as an insurance policy. It's a rarity that you get paid to hold an insurance policy. And in fixed income, you're getting 4% on a 10-year bond right now, a 10-year US Treasury, to hold something that ideally appreciates if we see a fall in the economy. So having a good mix of assets, having a diversified portfolio is very important, and fixed income is still a very important part of that diversification. Thank you for listening to what we have to present on the Outlook today. We look forward to seeing you soon and continuing our discussion on opportunities in the market. Have a great day.